uh, let's come to our next segment, and a segment which I consider the most important one. So we have heard a lot about investing, a lot about investing. You should invest, invest, invest. So I wanted to know what are different types of investing. Okay, what are the different options a person has? Okay, let's start with the basic ones. Let's say a person who is listening to this podcast who has no financial knowledge, let's say what he can do, and then let's go to the advanced investing
Hmm.
options.
Uh,
Over to you.
Before I start talking about different options of investing and everything, I would also like to mention another point. When we think
Mhm.
about inflation, we also need to consider how much our money is growing. So when we say
Hmm.
when we say that in FD we are getting 6%, 7%, always I think this is an advice for everyone. You should always subtract the inflation rate. Just Google what is the inflation rate of India this year. Just subtract it, and
Hmm.
that's your real growth rate of your money. So always keep inflation in mind, then only look at what options you have. Now when it comes
Okay.
to options, there are multiple number of options. I mean, obviously stock market is one of them. So in stock market, what you can do is you can invest in equity. So what is equity? First you
Hmm.
need to understand, and what is debt, you need to understand. So equity is the money that you have. I mean, the cash that you have, that you own. It can be the value of your house also. I mean, that's your total value. I mean, assets is equals to equity minus liability. You need to understand this particular equation first.
Okay, okay,
So
got it.
assets, all your assets. What are your assets? Your house, the
Mm-hmm.
car you own, the clothes you wear, and all those things that you can actually go in the market and sell off and get some cash for it, right? What are
Yes.
your liabilities? Liabilities
Right,
are something that,
loans.
yeah, exactly. In simple language, things for which you have to pay
Hmm.
today or
Okay.
tomorrow.
Okay.
Can be anytime. It
Okay.
can be tomorrow also. Loans,
Mm-hmm.
basically you pay little, little, little for something, for a benefit that you have availed right now. Okay,
Hmm.
so you're basically paying for that benefit that you availed right now. That's called liability. So overall, your equity will be something that you actually have. So
Right.
so for a company, if you when you invest in a particular company, let's say buy the stock of Reliance, what I'm doing, I'm earning a certain percentage of I'm owning a certain percentage of Reliance, right?
Yes.
So this
Yes.
is stock market. You can also give loan to Reliance. Now what you're doing is that you are buying debt. When we say I'm investing in debt, so what I'm
Mm-hmm.
doing is that I'm buying debt of Reliance. So basically, I'm loaning some money to Reliance. When I'm say I have bought debt of Reliance of 1 lakh rupees. So
Okay.
basically, that 1 lakh rupees has been loaned to Reliance, and for which they will pay me back certain extra money that will be interest. So it can be
Hmm.
6%. So let's say I paid them 1 lakh rupees today, and I expect them to pay me back 1,06,000 after 1 year. So that
Mm-hmm.
will be investment in debt. So in general, you
Okay.
can
Okay.
invest in a particular company in two ways. Either you invest in equity or you give them loan, that is called they invest in their debt.
Okay.
So how do you invest in stock market? Simply just get a demat account. Any bank, you can just call up any bank customer care and just get a demat account. That's it.
Okay.
It's a very simple process. So now we need to understand, okay, this is stock market. What are other options for people who don't understand stock market? Because
Hmm.
let's be honest, I mean, it's again a gamble if you don't understand stock market,
Yes.
don't
Yes.
have the knowledge about what business this particular stock is in. So for them, the most useful instrument will be obviously mutual fund. And the,
Okay.
and today one of the instrument that is very popular is exchange traded funds, that's called ETF. So
Okay.
ETFs are a very interesting instrument, to be very honest. So uh, through ETFs, what you can do, you can invest in gold also. So what the with the help of technology, what we have done is that we can simply peg the value of the ETF to the value of the gold. So let's say in the market, the price of gold today is 40,000. It
Mm-hmm.
closed at 40,000. So the ETF value will also close at 40,000. So basically, it's just
Mm-hmm.
mimicking the movement of gold. So
Okay.
in
Okay.
short, without actually owning the physical gold, you will be owning gold.
Got it. Got
Very
it. Got
simple
it.
concept. I mean,
Yeah.
and look at the ease with which you can sell gold. For right now, if you have gold physically, if you have gold, you have to go to the market, sell it, and get cash. And again, there are a lot of risk related to handling cash and everything. But ETF, you can simply own gold without actually owning it physically. So ETF can be
Wow.
for anything. ETF can be
Okay.
for wheat also. You can come up, JP Morgan, let's say it's a bank. It can come up with ETF of let's say Virat Kohli's run. If he scores 100,
Oh.
the value of that ETF will rise. He gets out or not. Let's say the number of scores he makes, according to
Hmm.
that, the movement of ETF will be. So it can be anything. ETF can be pegged to anything. So that's a very, very useful thing. To be very honest, I
Wow.
think. And people who don't want to own a particular stock, they simply want to invest in stock market. You must have heard that Sensex dropped 100 points today, 200 points today. So what is Sensex? Let's touch upon that point also. So
Hmm.
Sensex is nothing but a group of stocks, right? So Indian stock market had multiple number of stocks, Reliance, TCS, Infosys, and many more. So these large companies, they are given certain weightages, 10%, 20%, 30%, like that. They're given certain weightages. So Nifty has 50 stocks. 50 stocks will be given different weightages depending upon, it can be different factor. I'm not sure which factor Nifty uses and Sensex uses, but it can be like, let's say, the market cap. It can
Okay.
be, let's say, the revenue. It can be anything. It can be pegged to anything. And then certain
Hmm.
weightages will be given. So 5% for Reliance, 2% for TCS. And their stock prices movements is tracked by that particular index, as simple as that.
Okay.
So
Okay.
that is called market movement. So if market moved 300 points, so in general we say that, okay, on an average these large stocks move 300 points, because it's basically we have averaged out all these listed stocks. So you can directly
Hmm.
invest in ETF of a market, ETF of
Oh.
50. Yeah, simple, just invest in it and forget about it.
Wow.
You
I can invest on ETF of Nifty.
Yeah, ETF Nifty. So it will be
Okay.
doing nothing but mimicking the movement of
Movement
Nifty.
of Nifty. Okay.
That's
EFT,
it.
ETF is such an amazing concept. I didn't know
It's
about this.
it's one of the most useful ways of investment currently. I can even like you, there are a lot of ETFs that we can discuss. I mean, off the podcast, I can tell you what ETFs to invest in also.
We'll have another podcast about that too. But
Yeah, so I mean, you can
yeah.
just invest in it and forget about it. So it's very easy. I mean, in
Okay,
today's
if you
world,
would like to tell us uh, two, three ETFs that you would advise someone who's just starting out, maybe, or anyone.
so I mean, a lot of people would have come across, if at all they are anyway minutely close to related to financial markets, they would have come across this company called Small Case. So what they do is that they are just making up ETFs, and they post on it. So basically they charge certain fees. Obviously the person who will be managing that particular portfolio, because you need to actually, that person is going to actually sit there and invest in the stock market for you, because there is no actually mechanism in the stock market to actually, like, just invest in an index of stocks. You
Okay.
have to individually buy the stocks, right? You have to individually, when you say that I'm mimicking Nifty and Nifty has 5% of Reliance, so you actually need to go out there and physically buy
Okay.
5% of Reliance. So it's a very difficult task. That's why they charge certain fees for it. They are
Okay.
like portfolio managers. So
Okay.
they'll be
Okay.
managing portfolio for you. So Small Case is a very simple instrument. Not instrument. It's a company that is providing these ETFs. So if you own HDFC, if your Demat account is on HDFC or let's say ICICI, you can simply search on Google how to invest in ETFs.
Hmm.
It will guide you. I mean, you can straight away go to that particular Demat account and just invest in it. It's very easy. The only thing is that it's the 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 amount that the investment amount will be a little larger. Why? Because
Okay.
again, it's a group of companies, right? So 5%. So
Hmm.
it will have stocks which might be priced at, let's say, Nestle is usually one stock for Nestle costs around 26,000. So it will be around 50,000. So usually ETFs of stocks I mean, indexes usually cost around 50,000. So if at all
Okay.
you have
Okay.
50,000, people who like to just invest like 5,000, 10,000 just to play around, it is not for them, obviously. But
Okay.
it's a very good investment instrument, to
But
be very honest.
you can invest on ETFs of gold, right? That was also a very
Correct.
nice concept.
Exactly. I mean, yeah, that's a very easy
Yeah.
concept, and you don't actually need to bring in that 30,000 because
Yeah.
one 10 gram of gold costs what 40, 50,000. You don't need to
Uh,
do that. I mean, ETFs will be around 1,000 rupees also. You can invest
yes.
10,000 rupees. Yeah, I mean, it's a very easy concept.
Yes. Also, because as you said, if I want to sell my physical gold, it's tough. It will take time. But if I have
Yeah,
virtual gold, it's
yeah,
so easy. So yeah.
very easy. It's very easy. And
Hmm.
then other instruments, obviously mutual funds and everything, people might be knowing it. Mutual fund is also same kind of thing is there. I mean, mutual fund managers, I mean, these portfolio managers are very trained professionals and they know about financial markets. So basically you invest in a mutual fund and they invest your money for you in multiple
Okay.
stock markets. Now the thing about mutual fund is that it also has debt also. So they have this portfolio in which they not only invest in equity of companies, they also invest in debts of companies. They invest in sovereign bonds also. Sovereign bonds are basically the debt taken up by the governments. So
Okay.
Indian government issues bonds. So
Hmm.
basically, when you buy, let's say, 1,000 rupees bond, what you're doing is that lending the 1,000 rupees to the government in return of, let's say, 6% in 6% return. So basically, they'll be returning you if you're investing 100 rupees. So let's say they'll return you 106 rupees after 1 year. So
Yeah.
sovereign bonds are there, multiple instruments are there. So again, so I think mutual funds, ETFs, and these two instruments are for those people who don't have any knowledge about financial markets. You can simply put your money, forget about it, do your work,
Hmm.
come back with much more money. That's it, simple.
Nice.
Yeah.
Ah, a lot of options that were thrown. So if what I understood, let's say for a person who doesn't have a lot of knowledge, he can invest in a mutual fund or an ETF. That is the best option for him.
Correct.
Let's say someone who has some interest, then
Mhm.
he can read about the market, read about companies, and maybe invest in equities or
Absolutely.
debt, as you said.
Absolutely.
So yeah, so this is how we should go for it. Also,
Yeah.
one more important thing that you touched upon, I just like to reiterate is whenever we invest in, let's say, a fixed deposit or something, and they give us an interest rate of 8%, we always need to subtract that with the inflation rate to
Correct.
actually understand what we are getting. Okay, that's wow.
And just to like let you know the return or what kind of return usually you get on FD. FD you get 5%, around 5 to
Yeah.
6%.
Hmm.
In stock, Nifty usually gives, stock market gives you 11% return. Definitely. So if you basically invest in ETF of Nifty, any ETF that is available, your money is definitely going to grow at least 10 to 11%
Hmm,
on
hmm,
an
hmm,
average.
hmm.
9 out of 10 times, 9 out of 10 years it is going to grow at least 11%. 1 year obviously, like an exception of, like, let's say 2020, 1 out of 10 years there might be a chance that your money might not grow 11%. It will not grow even. And if it if unfortunate events occur, and it might not grow, but definitely 9 out of 10 times you are going to get at least 10% of return. So obviously it's much more better to invest there than leaving the money in FD, which is giving you 6% return, and inflation is eating out of 4% out of that
Exactly.
6%. So it's totally waste of money.
Exactly.
Yeah.
Wow. And also the fact that you're stating that 9 out of 10 times it will increase. It is on the basis of like past so many years that we have
Exactly.
actually. So it's
Exactly.
like it's foolproof. That is what I know. So yeah,
Yeah.
exactly. That's a very good tool of investment.